So I'm Richard from Fireblocks. I've been with the company since about March this year, but before that I was a client for a year. We're not a new company. We've been around for about 3 years now, but relatively new to Switzerland. So I'll just spend a few minutes to discuss a little bit about who we are and what we do. There we go. So Fireblocks, we're a technology company that provide financial institutions with infrastructure to store, transfer, and issue digital assets. It's based fundamentally on an in-house developed multi-party computation technology. And then on top of that, what we've done is build what's called the Fireblocks network. It's an asset transfer network. So if you think of it like Swift for digital assets, counterparties on the network, so i.e. clients running Fireblocks technology are able to securely connect with one another, think of like a messaging layer in order to transact. So that sort of process of mutual whitelisting, exchanging deposit addresses, that doesn't exist on the Fireblocks network. You say if one entity wants to send funds to another, it's a question of finding them using an LEI type for unique identifier in order to securely send funds. So it's a network that is enabling digital asset transfers with a high degree of automation. And I think since 2 years that's been live, it's seen over $1.5 trillion of digital assets transferred through that network. A little bit of background of the team. So the core expertise of our founding team is cybersecurity. Essentially, one of the principal risks that you face when you scale a digital asset operations is you're actually dealing more with a cybersecurity risk. It's far beyond just managing private key material. So that's sort of where our founding partners are coming from. And then on the independent board and advice, we have people like Jay Clayton, former chairman of the Securities and Exchange Commission in the United States, Gilles, fintech sort of prime brokerage background, founder of Triana, and I always mention Professor Ran Canetti. Professor Ran, he advises our research and development team, which we keep in-house. So the MPC, multi-party computation algorithm that we use is called MPC CMB. It was invented by the Fireblocks research and development team together with Professor Ran. So MPC CMP, Canetti, Maria Cananos, and Pellets. So the latter two are both part of Fireblocks research and development team. I should note as well that MPC algorithm is open source, as Lamine highlighted, so it's peer-reviewed, it can be used by others, and I think that's also an important piece of any sort of technology business, is that if you're able to open source it, others can use it, it helps develop a market standard for implementations and really scaling this market. Because the one difference that we see when we talk about financial services or technology businesses, technology business, you have Googles, you have Facebooks, you have Amazons, they just want to dominate the entire world. It doesn't work in financial services. Financial services, there's always a buyer, there's always a seller representing their own personal interests. So it's very important that you have a lot of connectivity and collaboration across the market. So 2 years since the first client, we had about 9 months of stealth mode, and then we went live. We've raised a significant number of capital, just shy of $500 million. That's as much as a commitment to our clients than really just parking it in the bank. You need to have financial security as a business. Mainly VC funded. We have 1 or 2 strategic clients who also invested in us. I think BNY Mellon is probably the most notable. And we're about 200 or so staff scattered around the globe, headquartered in New York, R&D's Tel Aviv, and coverage just about everywhere else across the world. So we have 600 plus institutional customers covering every corner of the market. So pure B2B players, OTC market makers, brokerage firms, custodian banks, neobanks, Revoluts of the world that face a large number of retail customers. So really showing the dynamic use case of the technology. And then maybe just fundamentally what I'd like to talk to you today about is, by the way, excuse my terrible PowerPoint skills. I haven't done PowerPoint since I was at high school. But really a fundamental question that we speak to potential customers about financial institutions, banks in particular, is a question they ask themselves, like, am I going to do this in-house or am I going to sub-custody with a third party? Now, this is not, I think you can see where this is going to end up, but it's not me to talk shit about sub-custody, because quite frankly, there are a lot of good reasons why you would want to sub-custody. Things like, time to market, the cost, you basically have variable costs. It's not free to set up a digital asset business, core expertise of a sub-custodian. But really, as we go through this, there's a lot of things that you need to consider, that maybe on day one aren't as relevant, but, as you sort of, go through this sort of process of setting up an operational business in the digital asset space, there is only one sort of consideration that you should be making. So first up, what I'd like to speak about is sort of the timing restrictions that you face with a sub-custodian. Usually they work from an SLA, call custody, 24 hours, get your assets out. This is a 24/7 market, or even in traditional assets, it's almost 24/5. So you need to be able to move at the speed of the market, and really you need your assets, when there's volatility. You need them fast when you need them the most. So I give an example. We serve probably the majority of the regulated brokers and dealing desks who operate in the cryptocurrency space. They settle post-trade over the Fireblocks network, so it's quite different to maybe pre-funding with an exchange. Those folks were trading 24/7 on March 19th. March 19th was 30% drop in Bitcoin. I think it was in about an hour. Every single exchange had problems. They went down. There was trouble crediting deposits, making withdrawals. So if you're moving assets from one to another or changing up your margin, that simply didn't happen. On the OTC side, they quoted 24/7. Fireblocks customers settled, and they settled on a net basis. They settled over $21 billion that day, so uninterrupted service. It's a critical component from a bank to remain operational throughout all trading hours. Other areas, adaptability. If I can say my own experience working in a bank, in terms of the systems, it's a bunch of systems that don't speak to one another. Nothing connects. There's no interoperability, and you're going to face that as well with potentially with sub-custodians. There's often limited interoperability. They offer some API connectivity, but certainly you're going to be duplicating process, which of course brings a new inherent cost to what was supposed to be something that's more cost efficient, right? This is going to be cheaper if you do digital assets and implement this stuff. Whereas, using in-house custody, you can integrate it into order execution management systems, reconciliation, reporting, core banking systems, and of course important AML and KYT. If I just sort of put a line in there, AML compliance, pretty much the major players. You've got to say they've got their houses in order these days. Everyone is using blockchain analytics software. It's actually a market that you really can put a lot of risk and controls around. That said, as a bank, reputational risk is probably the number one risk that they want to manage these days. No one wants to be tainted, with some negative news or anything like that. So it's something you need to be able to control in-house. It's also something that you're able to highly automate using in-house indirect custody, and you, of course, remain in control. Whereas you do take a bit of risk when you farm that out to a sub-custodian, and any legacy business that comes back later could also risk tainting your operation as well. Reputational risk, very important. Closed loop, usually, so I think others have already mentioned, sort of the operating model of these, exchanges and things like that tend to be, full vertical stack. They're the broker, they're the marketplace, they are the custodian. That also means that you only trade the products they offer, the assets they support, the assets they support, and what if your clients want to trade something else? Well, you can't. So maybe they'll go somewhere else. Maybe they'll find another provider. So with an open network using direct custody, you have the option to add the products and services to your clientele much more on demand. The time to market, of course, is much faster, which is around future-proofing. So you can dictate your own roadmap. I'll come back to this a little bit on the next slide. But of course, if you're if you're relying on a trusted partner, you will be more aligned to their roadmap rather than dictating your own. And then just a final mention on the risk side. What I've seen so far in the past few years is, banks, financial institutions in general, they're happy to take technology risk and can get comfortable with that, but what they're not comfortable taking is things like unnecessary counterparty risk, operational risk, in addition to that. And I think also what you're looking at here on the right-hand side is kind of what the system looks like yesterday. Farming everything out, counterparty risk, operational risk to others, whereas you've got this sort of the ability to take this new technology and use it and mitigate some of those financial market infrastructure risks. So why would we continue to make the same mistakes as before? So why is direct custody so important? I'd say my career in digital assets started in 2017 when the topic of institutional custody really took off. It was more about burying Bitcoin in a Swiss nuclear bunker than thinking about what might come later. So the custody story really didn't, the book didn't stop with custody. It was just getting started, and as many of you probably have realized, this market, it changes so quickly. Decisions, you have months to make decisions, not years. So you can quickly lose and fall behind the curve, and that actually stands for any developed business. The Coinbases of the world's right at a startup. You're actually only months away from cocking it up. So if I look at two products and services that fairly, came in with sort of, the 2017-18 to 19, it was really about adding on, building on top of that custody and saying we want to add our clients the ability to trade and then also lend, which are so closely linked. That was also a point in time when technology started to reach its limitations. So when legacy systems were starting to be either sunsetted or complemented with use of multi-party computation, something that is pretty much relevant in every institutional offering these days, an element of using MPC, really getting rid of the single point of failure of a private key ever coming together allowed for a lot more applications and able to automate a lot of your processes because you didn't have to worry about running over to a piece of hardware with a YubiKey or an iPhone or something like that. And particularly when you get into the sort of the traditional sense, and you look at settlements that take place, millions and millions of settlements every day. There's no way that's going to be a manual process. So MPC started to come in, and that's of course was required because now, the years later, you need to interact with the blockchain a lot more. Things like staking services, it requires constant uptime, high availability. It's a revenue stream you're going to lose out on if you're not sort of keeping pace with the market. Decentralized finance, it's not really a thing for the banking system yet. Why? Because it's very difficult to apply corporate governance, or operational governance around that direct interaction with the blockchain. Many of the providers speaking today are already covering that off. So now banks can start to interact with DeFi. In the grand scheme of things, there's a lot of incremental steps before that really sort of takes off in the traditional financial space. But if you say to a Credit Suisse or a UBS or a JP Morgan, say, you can swap Apple for Microsoft shares with missing both cash legs in between. Damn right that saves them a lot of money. Damn right it's interesting to them, but it's a long way before we get there. But you need to have the technology underpinning all of that that's going to support you through that stage. And then where we are today, looking at things like payment services, again, automation comes to mind, high volume, transaction volumes, numbers, compliance with new, regulatory environments. I think that was probably one of the hard, the things that, banks over the years struggle with. The fast changing regulatory environment really, needed banks needed to move quickly. Which is not the things they do very well. So payment systems, be able to have an adaptable system, a modular system, and then of course we'll say is the elephant in the room, and what really makes this as a, is tokenization. And on the tokenization side, if this becomes a thing, it's incorporating all of these different elements, because it's going to affect every single asset class that a financial institution interacts with. So when you're having a conversation with a financial institution, they're not actually just setting up a digital asset desk. They actually need to be thinking about, okay, what revenue streams am I prepared to potentially give up in future if I don't do this now? And when you talk about tokenization, they're considering, like, do I lose part of my trading revenue, part of my brokerage revenue, part of my credit, part of my asset servicing, potentially certain new liquidity, transaction banking. It's a much bigger consideration what they're doing. I think that's why you're seeing a lot of the bigger houses, the Sixes of the world, the Deutsche Börses, I suppose are good on the marketplace side. If this does become the thing, then they won't exist if they don't have the technology that underpins it. So with that, finishes off for me. Thank you very much for your time. It's my first time on stage, so if you want to give me shit, I'll be in the bar later. Thank you very much.